Thank you. Hey, Lisa. So, okay, so let's see. So, this right now we're just doing informal while we're waiting. So we just make good use of the time. So you're asking about what to do as opposed to what not to do, which is going to be the main talk. So first, it starts out. I'll give you a really big picture. So many startups that pitch, uh, they miss out. First, the fundamental thing of VC fundability. So what that means is that they are pitching something that a venture capitalist cannot invest in. Right? So if I put it the other way, if you want to get investment from people who invest in startups, and one of the main types of people who do that are VCs, venture capitalists, then you need to understand like what are they looking for. So I'll show you the detail later, but in a nutshell, they need to invest in businesses that can grow very, very fast and very large within a short amount of time. So typically between 5 to 10 years, these businesses should be able to reach somewhere around 50 to 100 million US dollars. All right? If it's a lot lower than that, and we see this all the time, startups that are pitching something that they're good businesses, they're even profitable or can be profitable, but because of the market size or because of the growth rate, the scalability of what they're building, they won't get that big. They might get to maybe, let's say, $10 million or something like that, or even less than that in 5 to 10 years, which again does not mean it's a bad business. But people who professionally invest in startups, they cannot invest in that size of business. It has to do with the financials, the KPIs behind those investors. So if we come back and if you ask me, what do you want to do? Like, what should you do to be a big bang and all that? It starts first and foremost with building something that the investor perceives will grow so fast and so big that it'll hit something like $50, $100 million within 5 to 10 years. All right? And how do you do that? So if you dig in one step further, how does that happen? First of all, the market size has to be really big. So the potential market, the number of people that might be able to buy whatever you're making, there has to be enough of them in the world. Right? If not, then it's like there's a ceiling. It's like saying we can shoot for the moon, but we'll hit the roof because there's only that many people who could buy our product. So you'll never hit that revenue. So you need to have a large market, or at least a market that will be large in that time frame. So maybe it's not large now, but because of something changing in the world in the next 5 to 10 years, it will be the moon, right? Something is really changing to make that happen. So again, number one is the market has to be really, really, really big, right, in the future. Number two, whatever you're building needs to be very scalable, which is just another way of saying you have to be able to repeat it and grow it very quickly. So what do I mean? We could make a really great noodle shop, delicious noodles, right? So, and just like people love them. But if you open this shop and you want to be $100 million, and you'd have to do that by opening hundreds or thousands of shops, it's really impractical or unrealistic that you can duplicate that quickly in that short amount of time. Right? You have to hire so many people, have so many different places. It's hard to grow that fast with a very bricks and mortar type of business. But if you're doing something that's very scalable, and one of the most scalable things, and this is why you see so many startups are built on software, is software. Software is like, you don't need a manufacturing plant. You don't need a factory to crank things out. You don't need too many people. We could right now possibly design something, and if it were really good, we could launch it today, and let's say it was excellent, right? It serves some market need. We could make it show up in 10 different countries in the next day if we really wanted to, right? You don't have to go open 10 different offices in 10 different countries. You don't have to hire hundreds of people or thousands of people. You can suddenly be there because of the scalability of that business and that product. So those are two really, really key things. It's not everything, but I'd say those are two of the biggest factors that just first and foremost. So you could have everything else, which is really scary. You could have a business that's very profitable, It's got great margins. It could solve a real problem. It could have all sorts of great characteristics, but if the market is not big enough, or will not be big enough, and if that business can't be scaled, it can't be grown fast enough, then it's just not going to be, it's not going to be fundable from these types of investors. Okay, so that's like number one. And you have broadcasts. Oh, Tinga, really? Oh, okay, okay. This is just informal, by the way. We were just talking for fun while we're waiting before we start. Do you want more? Any other questions in that direction? Because I could talk about it forever, but okay. Okay, so this is like a very open, free form before we actually do the real thing. This is while we have some time. Nice to see you again. So totally open. Would you guys like to ask some questions? Yes. Ah, good question. For the most part, it is not. And this is one of the dangerous things about, or not dangerous, one of the challenging things about the Thai startup ecosystem. In fact, from most of the Southeast Asian ecosystem, our markets are very attractive in terms of like the characteristics, the types of consumers, the potential growth rate, all these different things. But they're relatively small and fragmented. So if you were to just dominate one, such as Thailand, only, for most businesses it's not enough to be a very fully VC fundable, hyper-scalable business. Right? With maybe some minor exceptions, but for the most part it's not enough. And so to be that type of startup, you need to typically have a vision and a focus on eventually scaling outside of Thailand, at least regional, right? If not global. There are exceptions in our region, like Indonesia is huge. They're so big that they can actually just target their own market. Right? We can't. We're like almost, it seems like we're almost big enough to do that, but not quite. Right? So this is a complaint from a lot of investors. They see actually a lot of talent, a lot of great opportunities in terms of good problems to solve in our markets and in Thailand. But the barrier or the challenge is building something that's big enough. Yes? This is just sort of startups in general. So yeah, it's not exclusive to software. Physical product. I mean, it depends. I don't have a hard and fast rule about it, but just the general perception is that just our market is not big enough to be enough alone, right? But it's just that as soon as you ask that, we shift into a different mode, right? Because remember at the beginning of our conversation, I said that most of these businesses need to be hyper scalable. So most physical products are not quite as scalable. Or the ones that are still have difficulty seeking funding. So the fact of the matter is just a lot of investors don't like to invest in them. Put it another way, there are very few investors who like to invest in hardware. So the sort of like capital efficiency of it is scarier. Also, it's less agile. So if you think about it, when we build something in software and you throw it out there, and you need to tweak it, you need to adjust it. You can do that quite rapidly. But if you build something in hardware, it's unfortunate. Like you might have to have the whole cycle to repeat it and correct it is long and expensive. So those are some disadvantages. Other questions? Oh, we work. Ah. Yeah. That one's quite controversial. So you can see a lot of articles that question sort of how attractive WeWork is as an investment. It's not your typical. It's definitely not just software, and it's not really hardware either. It's really a real estate play, right? But then there's just characteristics to it that are a little bit different from the usual one. They're doing some things that to build more community, and I think they are using some technology behind there to enable some things, but it's not a real pure typical software nor hardware case. So it's its own kind of thing, I'd put it that way, right? But I mean, it's quite a force. There are certainly people who believe in it because there's tremendous investment and growth that's gone into it. But yeah, some of it is still to be seen. Just for those of you who are wondering, WeWork is essentially like a co-working community. So they go and they rent out, or they get property. They get property and then rent it out to people, startups, and businesses to work in. But it's huge. I mean, it's like a mega unicorn, so to speak. Other questions? Yes. Yes. Yeah. So that is part of a broader field that you can call, or we sometimes call deep tech. Right? And deep tech is one way to define it, and it's not a universal definition, but deep tech is a lot of technology that's typically not just software. It's either got hardware or life science or other components that make it less scalable, but it's also really fundamentally very interesting. It's very science and hardcore technical driven. So the value proposition that you can build is usually quite deep. That's why I call it deep tech, right? But the thing is, as you pointed out, it takes a long time. It takes a long time to have a scientific invention or innovation, to both to build it in the lab, to prove it, to get it regulated, all that stuff. So because of this, it, similar to the case of hardware, suffers the challenge of a lot less investment, or harder to find investment. And particularly, and this is something that we're trying to crack, and I'm actually looking at quite seriously, because we're running the Sprint Accelerator program here as well, which is Thailand's first deep tech accelerator. But it's like, I'll put it this way. Sometimes, let's compare, if you have a software startup, they could build something and prototype it and have users using it, and in many cases even have revenue. All that could happen in a short amount of time. They can take that, show it to an investor, and raise funds. Right? And one of the things when you raise funds is showing proof of this thing working, or the potential to work. But with deep tech, just to even get to the point where you have something in the lab, and it's like, okay, it works in the lab. Not even talking about commercializing, not talking about having users, any of that yet. That can be a long time. And it can take a lot of a lot of capital investment too to get there. So it means that when you're talking to investors at that early stage, they have a lot less, proof, so to speak. So yes, the appetite, the investment appetite has to be very different. It has to be someone who really believes and wants to have that type of investment, has the patience, right? But it's a trade-off, because they see that if it does work, usually if you can get through that technical risk, the market opportunity can be huge, be really, really big. So it's just that there's a lot fewer of those people. You're welcome. Yes. Yes. Okay. So we talk about that a lot. So I don't want to claim to have like the answer, and we discuss it among the community a lot. One of the sort of perspectives is that we are still quite early. I mean, Thailand's startup ecosystem really began in many ways around 2000. Let's say around 2012. If you look at the statistics, there were only 3 startups in that year that even raised funding, right? And then it went to hundreds within a couple of years after that. Right, so it was actually very, very, very early stage still, compared to like Singapore has been doing it much, much longer. So first, number one, Thailand is still relatively early. Yes, yes, and that was exactly. So the next thing I was going to say is that Vietnam is actually, I think it's not been around that much longer. I forget the exact date, but I remember looking at this thing, and it doesn't go back super far, but it has grown very fast. So there is something that they're doing quite effectively there. I want to claim to have like the exact analysis on why. Some of the theory, some of the common things that people say are kind of what I referred to earlier, which is about us being hyper local, meaning we've built a lot of things that are good, but they really serve mostly the Thai market. Right? So the majority of startups are still a bit focused on local. Right? That's one of the common things that's said. Whereas I think one of the hypotheses is probably that Vietnam and some other places have done more things that can scale more. Like one of the things off the top of my head, I don't want to claim this is the main factor, but I know they have a lot in terms of gaming. Right? So video games, when you build it a certain way, I mean, they can go out much further than just the local country. Right? What, is there a time that we're supposed to officially start? Oh, is it? Oh, okay. So we're still, okay, so this is still informal. Just so, please let me know before we go into live mode.
Like 5 minutes before, like 6:25.
Okay, okay, thanks. So yeah, still in totally open, free discussion. This is like not the actual talk yet. Anything you guys would like to ask about and learn about? Yes. Hi. You're what? Ah, yeah. Cool. Oh, in terms of accelerators. Interesting. Yeah, I was trying to figure out where you're heading with it. Accelerators. ROI for founders. Okay. And are you talking about in Thailand? Wow. Okay. Okay. Let's see here. Well, we have to give huge credit to DTAC Accelerate. I mean, they're quite the flagship out there. They've been very prolific. I mean, they're so strong as an accelerator that if you look on charts that show like who are the main VCs in Thailand, they're pretty much one of the biggest VCs if you consider them to also be that, right? So they've been doing it for a long time, and they're quite good. If you can get into DTAC, that's a good thing. There are a lot of others, but then it also depends. We have to step back. Like you're talking, is it specific to your business? Like the one that you just said you're working on, which has to do with impact? Okay. Okay. So hey. So and no worries, we're not filming it. This is like just casual. Um, so one way I would answer it is similar to the way we answer the question for investors in general. So whether in your case you specified like an accelerator, but even if you asked like VC or CVC, etc., think about what your product is, right? Your market and the things that you can benefit from, right? So, if, for example, like this I'm going to oversimplify a little, but if someone's doing a finance, fintech type of startup, there are a lot of banks, right? If you're doing industrial, B2B, IoT, robotics, SCG, well, they don't have an accelerator, but their investment arm is definitely, there's right now there's just so much activity from different sectors. So I would start with thinking about what it is that would be a high synergy for you in terms of what you can gain and in terms of the network and resources. Right? But if it's sort of like who's better at mentoring and all that, yeah, I wouldn't want to try to try to say that exactly. All right.
Could I ask something about education?
Sure, of course. Sure.
The thing always news stream, right? And when you say study in the business school,
Hmm.
do we still can catch up? What changed? I mean, those the curriculum, many things,
Yeah.
and it's what enough to invest. I mean, like Sasin, right? Pretty a big investment for studying here,
Ah.
and instead of investing in the stock growth stock market, um, I mean, do the curriculum in the business school can catch up those rapidly changing business environment?
Okay. Wow. It's a good question and a delicate question because I now also work at Sasin too. But yes, yes, no, 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 I'm not. It's a fair question, and I do want to answer it as best I can. So, and there's a couple of different things there. So I have to kind of try to
For
separate this up.
an example, I
Hmm.
just study the MBA course
Yep.
in Linda FX,
Ah, yeah.
Switzerland,
Yep.
what is the difference? I mean, I can get some micro degree, right?
Uh huh. Uh huh.
From maybe MIT or something like that.
Uh huh.
What's the difference? Can Sasin
Okay.
advantage of those kind of e-learning?
Sure. Sure. So again, I'm gonna have to chop this up into different aspects. It's not all one consideration, right? If we rewind all the way back to even before this disruption stuff, and we talk about why do people even join a business school, period, right? Pre-disruption. Um, you'll find that a lot of people, a big factor is not just the academic knowledge that they're getting. That's certainly one of the factors for sure. But one of the big things is very, very intangible, and it's almost like brand equity when you talk about businesses. But basically, it's the people, it's the network. So all the way from your actual classmates, the alumni, that whole network is immense. I can't even begin to describe because like what I'm doing right now came so much from that. It's incredible. And Lisa, same thing. She's does works with alumni now, and like Lisa over there, right? I mean, it's indescribable. The people, and I was born and raised in the U.S., so I had a very limited Thai network. And then Satsin really totally changed that for me, and the people I've met and the connections and all that. Yeah, so seriously. And that's not just for Satsin. So going back to business schools in general, a lot of people in the world when they join, it's for that is a big part. And you can never, I don't think you can replace that really with the e-learning. Now the e-learning, definitely from the knowledge point of view, I think that's something. And then even Sasin itself and a lot of schools that are starting to look to disrupt themselves and to transform digitally. And that's one of my tasks actually is to strategize and enable that. So we probably won't be standing still. We'll also enable that and to scale education that way too. Right?
When you're thinking of the structure, when you design the new curriculum,
Yes.
you have to get approved from the government. The government take very long time to get approved, and then things already changed before it get approved.
I'm not aware that that's going to be a particular factor for us. I don't want to to claim expertise on it, so I don't know. But to my knowledge, that is not necessarily going to be an issue for us. Also, there's a lot of body of knowledge that's going to be outside of the usual government scope because you referenced something which is like the type of knowledge that's not even in business schools, right? So right now, a lot of what's in the startup ecosystem, the things that people in our startup community deal with, are things that are happening out there and haven't even been introduced in academia yet. So that's one of the strategies too. So one of the reasons they brought me in and some and our newer team is to make that happen. So we're pulling in people from the outside, but putting it through the rigor and the standards of the school. So to come back to your question, basically, even here, they're not standing still. They're bringing in that knowledge from the people who know that knowledge, right? So yeah. So we're still in the free form discussion. This is like totally open Q&A before we get into the real talk. Any other things you guys would like to ask about? Just wondering, totally, can it be about startups, startup investment, VC, accelerators? Yes?
So I'm in the thick of this, so exploit your presence here.
Exploit.
Make use of.
Okay.
So I suppose I'm still pre-launch stage.
Oh, okay.
Trying to whip up my traction.
Mm-hmm.
Having a campaign, or big first campaign coming out next week. Background aside, I'm just wondering, like in terms of equity investment or convertible, at the convertible notes, let's say.
Mm.
Like, what are the odds of someone having like a product or service at my stage,
Mm-hmm.
getting this support in Thailand?
Ah, okay. So you're wondering what's the probability of you raising funds, basically, right? Okay. So you're about to launch next week, is that right?
It's a pre-launch still. We're still scaling up the network.
Okay.
Building the database, essentially, for the users. The actual launch date will be in Q4 of the year.
Ah, okay. Can you describe a little more of what it is? And just add some color.
So I'm running an intelligent solution for impact sectors, so non-profit,
Mhm.
UN,
Ah,
World Bank, Oxfam, Greenpeace,
Yep.
Amnesty, aiming to match both sides of the ecosystem, so
Uh-huh.
organizations and talent.
uh-huh.
It being, very time-consuming, taking about 2 months or more.
Mm.
Sourcing for candidates, but also candidates taking too long to identify and actually land a job. So our proposition is that we are shrinking that down to 7 days. Through our currently building matching algorithm as well as the software side.
Ah.
So matching is one service, another one being a coaching.
Mm-hmm.
So that's a sort of professional development.
Mm-hmm.
Building the network, but also wanting to have our talent to be market ready for the sector. So yeah, so we're building the both network, the talent pools,
Mm.
essentially. Yeah, I mean the scale, basically the idea is a global startup since day one.
Mm.
We're doing it in Bangkok, leveraging Bangkok as a regional hub for the non-profit sector as well. All the UN agencies are here, World Bank, and a few other INGOs as well.
Okay.
So I guess I'm getting into a space where I started to look more for more funding a little bit more seriously,
Uh-huh.
to help with the software development, but also the actual pre-launch promotion.
Do you know how much funding you're going to be looking for at this
We're
stage?
raising about 250K
Okay.
seed, and then
Okay. All right. So let me sort of chop this up again too. So the first thing is, if it were just your typical digital startup, right? And I'm saying that because yours has this social impact element, and it sounded like there's some parts of it that might be less scalable because there's this coaching and other things involved, right? So I'm going to take that out of the picture for a moment. But if you were a typical digital startup, if there's such a thing, and you wanted to raise 250K, that's pretty much getting into what's called a seed round. And these days, the main thing is to do that. Is one of the most important criteria is to have some form of traction. Right? And traction is just really another way of saying some measure that your product is working. In the best case, if you're really lucky or you're doing really well, it's revenue and it's growing, right? And it's a lot. But even if it's not, it can be users, right? And you're seeing people use your product, and there's retention and there's growth. So it's actually showing that your product is being used and repeated. So these days, if you're raising that amount of money and you don't have that to show yet, you haven't launched, and you don't have a chart basically that shows it, it's hard. It's not impossible, but it's quite hard. Most people, because of the competitiveness of how relatively easy now to get there, it's this just like the stakes are, the table stakes are higher. So if you wanted to raise that much, normally I'd say you need to go ahead, go with a launch, and show metrics to a certain amount first. But yours is compounded though. There's both a plus and minus. On the minus side, it sounds like you have some things that make what you're doing less scalable than that typical startup.
That's a secondary
Or
service.
study? Oh, okay. Does that mean you're live? Oh, okay, soon. Okay, so let me finish this one before we live. Okay, and then so there's the scalability, and then, but then there's another side that might be interesting is the types of investors who might be interested in your business. They might be different from the usual VCs, and their criteria may be different. So these may be sort of social venture and other folks. So it might not be fair or totally representative to use a type of criteria that I'm used to. I'm definitely much more on the more pure VC side. So it'd be worth checking and worth talking to some of those folks. But again, kind of like with deep tech, kind of like with some other things, there's a lot fewer of them, so it's quite tough. So do know that it's a tougher battle. Okay, sure.
Okay, Sam, I think we should start.
Sure.
Sure.
ไมโครโฟนเหมือนเสียงแตกจริงๆนะครับเราไมโครโฟนเหมือนเสียงแตกนะครับเรา adjust ได้ไหมครับ
Sound that clear to you?
Does it seem like is it breaking up a little or test 1 2? That seems better now. It seemed like it was breaking earlier. Okay. So now you want to intro me?
Even though it's a bit. Yeah. So it's time to start for like formal introductions for คุณแซมนะครับใช่ก็ okay let's start okay okay welcome good evening everyone welcome to Entrepreneurship Sundowner at Sasin. My name is Vasu Siripa. I'm a Chief Impact Officer at Sasin School of Management and welcome everyone again. Like it's good to see familiar faces here again. And I think you already heard about Kun Sam a little bit, and we heard hear a little bit more from him. Let me introduce him a little bit. Kun Sam is a CEO and co-founder of Style Hunt. He is also a board member of Thai Venture Capital Association, and of course, a director of Sasin School Sustainability and Entrepreneurship Center. He's just joined us for 2 months. 2 weeks. 2 weeks, right? Okay. Sorry. Yeah. As an executive director of Bangkok Venture Club, Kun Sam has helped to screen thousands of startups, like for nearly half of 600 angel investors, VC, CVC, private equities funds, accelerators program, and senior corporate executives. In addition, he has judged and mentored a dozen of programs, including Startups Thailand, DEPA, Spark, Sprint, Steel Stars, and lots more. Like okay, so without further ado, please welcome again Kun Sam.
Thank you so much. Thank you, Gunpan. All right, you seem so familiar. All right. So we've actually had the pleasure of talking for like the last half an hour, but now we go into the official mode. So thank you very much for coming. I'm going to jump into, first of all, a quick intro of Bangkok Venture Club so that you kind of see where am I getting my perspective from. Okay, so as we kind of advertise, I've seen a lot of pitches and I want to share some of the pitfalls of how come I've seen so many. Well, I run this thing, I'm executive director for something called Bangkok Venture Club. What we do is we identify early stage and seed stage startups. Originally we focused in Thailand, and then later we started looking more broadly out in Southeast Asia. And what we do is we bring them to our screening committee. So we have a team of about 15 people or so, comprised of different kinds of investors. And so they come and pitch to us, kind of like a Shark Tank, if you will. Right? And then we choose the ones that seem most ready to come and pitch to our main members. Right? So for that, we bring them in, and we have what's called our general meeting. We hold that once every other month, so 6 times a year. Our members are comprised of almost 600 people. They are angel investors, but they're also VCs, venture capitalists, corporate venture capital, CVCs, private equity, accelerator programs, government stakeholders, and other ecosystem stakeholders. Right? And what happens is when they pitch there, we do this at a sort of a big banquet room over dinner, and they take turns, and then once they're done, it's a free-for-all. So if someone is interested in someone else, they can talk to each other, and whatever happens is between them. We don't take any equity, and we don't charge any money. And this has been something that's been helping the ecosystem now since around 2014. It's actually resulted in real deals from angels, from VCs, and from CVCs. And this is kind of a little scene of what it looks like there. Right? We are also a part of a larger network through the region of 8 different countries. So these are clubs, angel clubs, all around Southeast Asia. So we're connected in even a larger group. But before I get into the main thing, the original topic of this talk was about pitfalls to avoid. Right? So, because the thing is, we've seen so many pitches and judged so many pitches, we see the same major painful mistakes repeated over and over again. So what I'm hoping, either to the folks who are in this audience or who are watching online and watching later, I really want to try to help them so they can avoid that massive pain and increase their chances of getting funding in the future. But before I do that, a really, really quick intro on something fundamental, which is just understanding VCs or venture capitalists. Okay, so I have to preface this a little bit. Startups, first of all, they do not have to raise from VCs. If you can build something and it can succeed, it can grow, and you don't have to even raise money from anyone, wonderful. Okay? So even good VCs will say that. They say don't raise if you don't have to. Right? It's just that for a lot of these types of high innovation tech startup businesses, folks do eventually need to raise that in order to achieve the growth they need. All right? So in that case, these are the folks, or the majority of the folks, who actually provide that funding. Now, even if you don't raise from a VC, there are other sources of funding, but understanding how a VC works is helpful for understanding the rest of the context. So when we talk about pitching later, about what's good or what's not good, if you understand from the eyes of the VC, you understand their KPIs in a way, and their worldview, it makes everything easier. Instead of just saying, do this, don't do that, you can actually empathize with them, right? Okay, so on that note, so this is, let's say, a VC, which is essentially kind of like a startup. It's usually a couple of people who get together and say, let's make a VC. And they kind of do what a startup does, which is they raise money too. They don't take money from just their own pocket. They raise money from investors themselves. Those investors are called LPs, or limited partners, right? And they take that money and imagine they essentially put it into a pot, right? So let's say they've raised $20 million, $50 million, $100 million into that pot, right? And what they're saying is, let us hold on to that money and manage it for you for the next approximately 5 to 10 years. Now, this is not a bank, so you can't stick it in there and then bring your ATM card and withdraw money the next day, and you don't get interest in between or any of that. The money stays there, and then at the end of this whole thing, you'll get the money back, and I'll show you how. So the money is sitting there, and what they do is they take that pot, if you will, and they invest it in startups, right? So you kind of imagine they're sprinkling it across many different startups. What they hope is that over time, the value of the startups will increase, some of them, and at the end of this whole process of approximately 5 to 10 years, they'll get the money back plus more. So remember in this scene, at first the pot of money was this big, they put it in, and sometime later it will grow. If they make that happen, they will return that money to these investors. Okay? That's the game in the big picture, really fundamental. Someone's taking some money, holding on to it, managing it by investing in startups, turning the money, growing it, and then returning it back to the investors. Now, what do they get? In between, there's two main things. First of all, there is a 2% management fee, typically per year. So they need to take from that, let's say if they raised $100 million, then let's say 2% of that $2 million can be used to run the operations, office, personnel, to actually run the thing. But the main money is made from what's called carried interest. Carried interest, if we put it in really basic everyday terms, is kind of like a commission. What it's saying is, this money that they originally got from them, this one circle, if they turn it into these 6 circles, right, then the profit is this, right? They just made these 5 new circles. Right? So the VC will get 20% typically, around 20% of this profit. Okay, so they're incentivized. So the more they can grow that money, the more profit they can make from it, the more money the VCs can make themselves. All right? Now, continuing this with further, I need to emphasize all this stuff that I just described needs to happen in a short amount of time, in 5 to 10 years typically. They can't sit on it for 20 years, 30 years. Right? They have to go, invest in it, and get the money back at some point, return the money to the investors, and then get their profit, their share. So there's a limited time frame. Now, because of that, now we start to see the actual investing kind of mindset, which looks like this. They have that original pot of money, right? And they sort of figuratively are sprinkling it across many startups. It might be 30 or 40 or something, but just use this as an example. If they're sprinkling across these, what they know is that they're investing in something that's very, very high risk, inherently. By definition, these startups are high innovation, very high chance of failure. But if and when they succeed, they'll succeed big, right? What that means is they know that when they invest, most of them will not survive. And they're not tricking themselves. They're really clear. They know that by the nature of tech startups, most will not survive. But they expect that maybe one might just barely make it, but it won't make a big difference. One might do quite well, let's say 10x or something like that. That's a big growth. And then there's going to be one that's super big growth. Maybe 30x, 50x, 100x, but it's big. It's the next Facebook, Google, Alibaba, right? Something like that. So this whole thing, from a financial point of view, is the act of sprinkling across many where they know that only pretty much 1 or 2 will pay for everything and will make it all worth it. All right? Now, if you've got that, the thing is, remember that this is, in order for this to happen, this company typically needs to generate revenue roughly on the order of up to about $100 million a year within that 5 to 10 years. That's how fast it needs to grow, and that's how big it needs to grow. On a sort of rough global level, that's the approximate rule of thumb standard. About $100 million a year in 5 to 10 years. That's very, very fast growth. In our region, it can be sometimes a little more relaxed. I'm talking to some people, it might be around 50 million or so, and it's not a hard number. This is not a scientific, if it's 50, then okay, if it's 49, it's not. It's not that kind of rule. This is a conceptual, right, approximately. But you can see, though, the thing is, if the business is going to generate $10 million in 10 years, it's just probably just way too small. It's got to be quite big. Many tens of millions of dollars per year within 5 to 10 years. Okay, so there's not enough time to work out like all of the math behind it, but that's basically the result. Okay. Now, for this to happen, for a company to grow this fast and reach that type of level, there are 3 major requirements or key kind of characteristics. During the lifetime of the fund, so again, like 5 to 10 years, the startups need to have at least these things. 1, very high innovation. It can't be just like a commodity, like something that everybody has. It's got to be very different, quite defensible, and like it has to have a lot of value. It has to really solve someone's problem, have huge value and huge innovation. Right? Number 2, the market size needs to be big, really big. So if not enough people in the world will eventually be able to use this, no matter how good the model is and how innovative, they just can't grow that big. right? So the market, the potential market size during this lifetime of the fund has to be big enough. So let's say we said we're hoping they'll reach $100 million, right? In, let's say, 10 years. But what if the market size is, in the whole world for this thing they're making, is $150 million? That's, if you just think logically, if the whole market size is 150, for this startup to reach this size, to reach, let's say, 100, it's got to have like 66, 67% market share. That's very unlikely. It's like a monopoly, right? So that's unrealistic. So hopefully the market is much bigger than that. Right? The third thing is scalability. So even if you're very innovative, even if you have a very high value in innovation, even if there's a large market size, but if what you're building takes a long time to grow, for example, you have a business that requires a lot of humans, you have to hire a lot of people, and you have to buy a lot of property or build factories, it's just not as possible, it's a lot more difficult to grow that fast in that amount of time. And for this reason, you'll find, if you go look up like most of the unicorns, as they call it, like the companies that are worth $1 billion or more in this sort of startup world, so many of them are software. Why? Software, through its sort of use of technology, has this innovation, and the particular software they're building serves a large market, but the scalability is really big. So sometimes you build something, I mean, even going back to, let's say, the days of Microsoft, when you had to get a disk, right? I mean, manufacturing disks is not that big of a deal. It's not a big operation, and it doesn't cost much to manufacture a disk. So we can repeat it over and over and over again very quickly. Right? But when you do something that's not software, we have to build big equipment and hardware or buildings or hire lots of people. That's less scalable, and it's harder for you to achieve this speed. Right? So the point is that this type of investment is typically targeting people that have these three characteristics. Oh, one last thing just to note on this. Even when the company grows as fast, just so you know, the investor doesn't suddenly just get money from the company growing. It happens by what's called an exit. So let's say this company has grown and grown and grown, let's say 5 to 10 years later. At some point, it either needs to IPO, right, on the stock exchange, or get acquired. Someone buys them. Either way, basically what's happening is that the shares that the investors hold now become liquid, and they can sell them at that very high price now. And that converts into the money in this picture that they can return to the original investors, and then they can take their profit as well. Right? So this is emphasizing, again, the speed, not only the speed, but then eventually exiting, all within the time frame of this fund, which is typically about a 10-year lifetime. Okay, so I need to kind of frame that, because once you get that, everything else becomes clear when we start talking about pitching and the deck and all that. It all kind of connects to that in some way. So this is, I share this to be clear about that first. Okay. And one other thing, because particularly in Thailand, we have an exceptional characteristic right now, something quite special, which is we have a lot of what are called CVCs, corporate venture capital, which we have, in fact, one sitting over there, right? Me. Right, so corporate venture capital is a little bit different. I should say this because to be really fair, right? And this is something you guys can be proud of, right? So I just told you about VCs and they have their time limit, right? But CVCs, so this is corporate VC or CVC. The type of VC I described earlier, people call them a financial VC or institutional VC, right? For corporate, these actually typically use their own funds from a company. They're from a large company, so from Kasikorn Bank or from large banks or conglomerates, all these big companies, right? And they're investing their money. So And with them, they don't necessarily, sometimes they don't have an end of fund life. They don't have that time limit. So it does put a little bit twist on their investment criteria sometimes. Also, their objective is sometimes not just financial return. It can be financial and or strategic. So if you are a large company and you are investing startups, you might not be just trying to make that profit that I showed, that straight way that I was showing. You might be looking at, if we invest in a startup, we may gain a certain kind of technology or synergy. We may be able to enable a new business unit, right? Or some kind of strategic value. So that's kind of what this is communicating. This is a slide, by the way, from a good friend of ours in the VC community, Paul Ark, Managing Director of Digital Ventures. Okay. So I won't go into this in full detail, but just as a note, that's something you should just kind of know on the side, right? We have a lot of CVCs in Thailand. Okay, so now we get to the original, this is the actual original objective of this talk. The main inspiration of this is because I've seen so many pitches and so many of them fail a certain way. I want to just give you a whole list of a bunch of things that people often do so that either you can avoid them or you can tell your friends to help avoid as well, all right? So the first thing is on the subject of slide design. So I know I've been talking about all this financial stuff and now we get to really nuts and bolts. When you make slides, one of the things, too much text. We see this a lot. They're pitching and there's just a whole bunch of words all over the screen. You can barely even read it. That's not good for this type of pitching. This is not a business plan. It's not a book. You should have very little amount of text. Next, still related to text, is that it can be very hard to read. A lot of times the size of the text and the color is chosen in a way where the judges or the investors are just squinting and they don't know what it says. So seriously, that could just ruin your pitch. Number 3, too much information per slide. So some of these are super dense. I feel like it's like when we're doing exams and you try to put on the little notes on one A4 paper or something like that. It's just cramming too much in there. Don't do that. Graphs. So a lot of times we see graphs and there's just no labels. You see lines going up and down. You might even see numbers, but what is this? Is this number of users? Is it dollars? Is it cost? What is it? The currency is often not labeled. That's a huge one. Is this baht or USD or Singapore dollars? And I know this sounds as really like such a minor thing, but we see it all the time. Is this like the last thing you want to do when you're in this big pitch opportunity? Another one is pitching too long. So in hardcore sort of demo day competitions, they usually have an actual set time. So there's an actual buzzer and you get stopped. Now in some places they may not have that, but there still is some sense of time. So for example, in Bangkok Venture Club at our screening meeting, if someone goes too long, the problem is the investors don't get a chance to ask questions because there is a slot, there's a next appointment coming in, and you just burned all your time talking. And the investor's usually thinking, okay, I was confused about this, I want to check this, I want to understand this, but they didn't even have a chance to ask a question. And they care too, they want to ask, but if you use up all the time, then you won't have a chance to answer. Right. The next section is the problem. So usually, I'm dividing this into the main sections that are usually in a pitch deck. So again, I'm not sort of teaching what are the things in a pitch deck, but I'm giving you from the highlights from certain sections. So one of the first sections is the problem. It goes like problem, solution, revenue model, market, et cetera, et cetera. Okay? So the first section is the problem section. Now, this is an important one. The pain is too small. So presumably when you're building a startup or business, yes, it's some kind of cool solution. There's something you're excited about in terms of the technology. But at the end of the day, presumably, it's solving a problem. It's addressing some kind of pain point for someone. Right? So in the problem section of the slides, what you're doing is you're telling a story of that pain. The thing is, a lot of times when we hear these pitches, the pain is not big enough. It needs to be a really painful pain. And so one way people call it is that it's something that requires, it should be requiring a painkiller. Right? It's like you're building, if you're making, are you making Tylenol, are you making paracetamol, or are you making vitamins, like Flintstones vitamins or Blackmore, right? The more you build something that solves big pain, the more valuable it is, the more likely someone needs it. So when you tell this problem story, you should be able to see that it's solving something very, very painful. It's one of the most important things, and unfortunately it gets neglected a lot. They're just kind of saying something, and it feels like a lecture. It feels like they're just saying, look, in this industry, people do this and this and this, and there are these 3 problems. That's not pain. But if you say, this is a person who's doing some kind of task, their steps are 1, 2, and 3, it takes this much time, it's extremely challenging, it's very difficult, you can see, what the pain is, and it's a very, very big problem. That means there's a chance that it's valuable. Another one is targeting too many pain points. So we see this a lot. Someone's pitching and it's like the slide is full of pain points, but there's just too many of them. We don't know which one is the real one, which one's the most important one, which one's less important. Typically I would recommend like maybe 1, 2, or 3 at most. But if you got like 5, I remember there was one with 7 of them. They pitched for 5 minutes, time for Q&A. I don't even have enough time to check, wait, number 1, let's clarify that one. Number 2, number 3, we run out of time really quickly. So have your clear, like just a couple of main pain points. Focus on them. And then pain points, quantifying them is a really important trick. So if I just say, there's this process that someone takes in some industrial application, and it takes a long time, and it's really inconvenient. What does that mean? How long is long? How is it inconvenient, right? Quantify it. It takes 30 days to do a certain kind of process before you can move, or whatever it is. Really be specific. Right? The tendency is we use a little bit too much marketing speak that just sounds good, but it doesn't really specify. This is one that's quite tricky too, is a lot of times we can't visualize the previous solution. So you might be talking about a problem, a pain point, but the key is this. Imagine if someone's pitching this to you, right? Do they understand how people do this thing now? How do they deal with this problem today? What do they use and what are their steps and why is it painful? Right? There's too many times that someone just says, for example, here, I'll use an example. Someone says, well, here's a story of someone looking for a job, part-time work at a restaurant, and they just have a lot of difficulty finding that work. And it causes pain for them because then they can't pay the bills and their kids are suffering. Now that sounds like pain, right? It sounds like there's a story and all this stuff. But we have no idea, like, what is that person doing today? So if they're looking for a job, are they going to a certain website? Are they going to a certain, what kind of resource? Who are they talking to? And then what happens when they go there? What's wrong with that current solution? Right, so when you're pitching, make it so the person understands how people do it today and why it's so bad. That's the real pain. It's not just the end result of the pain, but like what are they actually doing now? Okay? And this is closely related, is that we just can't imagine, we can't follow in our minds like what does that pain feel like? What's actually happening? Why is it painful? So paint that picture for them. So they have to go to website A, they search, they can't find the job listing, or in that site it just doesn't say where the location is, it doesn't have the information needed, or it's full of jobs that have already been placed, so they end up contacting the company only to find out the job's not real, right? Something like illustrate what the exact thing is and why it's painful. And so one analogy I'd give is the audience, and it sounds kind of bad, but it's like you're taking a knife and stabbing the audience and twisting it, all right? Obviously not for real, but like figuratively, that's what you're doing with your pitch. In the problem pitch, You are telling a story that when the audience hears, they can empathize, they can visualize, and they actually feel the pain. They're like, "Ooh, that's really painful." Okay, that's the trick. Why? The more that happens, the more value you're setting up for your solution. Because if it's like, "Ooh, it's so painful," well, here you go. We proudly present our solution, which makes that pain go away. That's the setup. Okay, the solution section. One of the most common things, one of our partners, he's the first to usually say, after hearing a pitch, he'll say, you know, this team that pitched, you guys seem really smart. But you know what? I still have no idea what you're doing. This is really, really common for so many investors. Like they hear a pitch, it sounds good, there's all this reference to technology, sounds complicated, but we don't actually understand what is it? What does this thing do? So crafting the language that makes it super clear and simple to understand is the first thing, and one of the main things that these pitches fail on their solution section. Now related to that is, and this is almost a trick too, let's say you describe, the solution is this mobile app, right, that uses, that allows you to find such and such a thing, all right? Let's say you describe this thing. But instead of stopping there, the trick is help visualize the use case. So explain, with this, here's how a user would use it. They open it up, they select something, they go to this page, they select this, they do this operation, this operation. Show them the flow, the user journey. It makes it a lot more tangible. Okay, so what I'm saying here is a lot of people don't do that. They don't help you visualize the actual use case. So illustrate that really briefly, and it'll help you a lot. Another one, too many features, right? I knew you. So we see these pitches, and it's like, oh my gosh, they just got this list of like tons of functions and features, and this is good, and this is good, and this is good. And it's not that you can't do that. You can build products that have so many wonderful features and functions, but certainly when you're pitching, you want to focus on the main ones, because otherwise it's just too distracting and we don't know what's important, what's not. Really want to focus on the key features. Maybe 1, 2, or 3 of them at most. Another one, this is more subtle, is that sometimes they just talk too much about the future roadmap. So they know in their mind they're building this, but then the next step is going to be this, and the next step, and then we're going to go target this vertical market and add this feature later. Now, this is something to really help a lot of startups, is that you can have that, all right? But separate that out into a separate section. So you have this problem solution where you focus on the main thing, but all that extra future stuff, it's like your roadmap, you put it in a section towards the end called your vision. The vision is a place where you can say, look, we're going to make our main product that we just pitched to you, but we can see that it doesn't stop there. There's so many other things that we can add, and there's all these other opportunities. And investors like that, because it's like saying you are not a one-hit wonder, right? A one-hit wonder is like a band that makes this one song that's great, goes to the top 40, and then you never hear them again. You're showing them there's going to be another song and another song and another song, right? So you can show that in your vision. And then another one is that it's not highly scalable. So this is less about the pitch, but just more about the product. So many startups that we see, especially in competitions in Thailand, are not scalable products. They're SMEs, they take a lot of manual work, it's just not a startup, and startups a lot of them don't know this, right? So that's something just really important to learn about. Okay, next section, business model. This is similar to what we said with the solution slide. So just as we said, don't have too many pain points in the problem, don't have too many solutions in the solution or features. Business model too. We see a lot of things where they end up showing, we're going to make money this way, this way, this way, this way. And there's just too many. And there's not a focus on which one is the main one, the real one. And this may sound really fundamental, but it's an important reminder. The business model is trying to tell you who pays who and for what. And a lot of times we see this fancy language and diagrams and all these things pointing around and stuff, but it's like, wait, really basic. Who's paying who, and then how much are they paying and for what? What do they get in exchange? Right? At the kind of the core of this thing. What's the price? So many times we see this thing, amazingly, we have no idea how much do they pay. Not only the actual dollar amount or baht amount, but also like, is it per user? Is it per transaction? Is it per month? What is the unit of measure of this thing? How are you charging? That's what we care about, right? That's like the business model. And in many models these days, many business models, the startup, the business receives some percentage of like a transaction. If that's the case, specify. So how much? What percentage of this transaction do you get? Don't leave it hanging and wait for the investor to have to ask. Or if it's a range, put a range there. And this is one that unfortunately, if I wanted to get into fully, takes about an hour. So I can't give you this lecture here and now, but it's on this subject called unit economics. So we just had one of the biggest tech conferences in the region called TechSauce. Actually, you're quite involved with that and make that. Good job, by the way. So TechSauce, huge. And one of the stages had hosted some VCs, this panel from Silicon Valley. It was music to my ears. One of them, they were discussing what's the most important thing they got to hear from a startup. And one of the first things out of their mouth was unit economics. Right? And this is something that's very badly missing in our ecosystem. A lot of startups still don't really understand it. Even a lot of investors, more traditional investors, still don't understand it. So I can't give the lecture now because it takes, again, an hour. But know that this is one of the most important things these days for assessing a business model in startups. And there are specific things inside of it called CAC, customer acquisition cost, LTV, lifetime value. This is a sort of fundamental COGS, cost of goods sold, annual contract value, and then what's called the CAC payback period. So even in the startup world, some people know this thing called unit economics as LTV and CAC. But just FYI, for those even if you know that, that's still not enough. Really, you need to know CAC payback period. Right, I'm happy to talk about it afterwards. And then another thing is just part of the business model is your channel. What is your sales channel? What's the process and the pipeline for getting those sales? Particularly if you use direct sales and it's not just online. Your channel is just as much part of your business and your business model as is how much you're charging and the costs and all that. And this is something that's very, very often missed. So if you talk to most savvy investors, they're going to ask you pretty quickly, what is your channel? How are you going to get customers? Next one, market. All right, so here's something that's quite frustrating, is people show, for market size, you end up seeing these graphs, like let's say a pie chart, and let's say, I'm just gonna make it up, they say this market size is $1 billion. It's huge, right? And let's say it's something like, I'm going to use an analogy. Well, first of all, the problem is a lot of times what they're showing is not really what's called the addressable market. So, for example, let's say we're making, I'll make this very, very tangible. Let's say we make steering wheels for cars. All right? Our startup makes steering wheels. And then we say, well, the automobile market is how many, I don't know, trillions of dollars. And we've put this graph up here. This is the value of all the automobiles sold in the world. What's the problem with that? Any idea? No source? Oh, that could be too, but. Okay, could be too. Okay, so I'll zoom right in on it. This is good we're talking about it. What you guys said could be the case too, but no, the main thing I'm actually emphasizing, if this is the value of all the cars sold, but we make steering wheels, right? So if we sold steering wheels for every car in the world, it wouldn't equal this number, because this is how much cars sell for, right? A car is like, I don't know, tens of thousands of dollars per car. The steering wheel is just one piece of the car. So the market size for steering wheels is only a piece of this. So this happens a lot. People say some market for their startup. They say, we're in the healthcare market. We're doing things for medical equipment. Last year, there was so many billions of dollars of medical equipment sold. But you're not just selling medical equipment that can be sold to everyone who buys medical equipment. They might be selling a chip that goes in there. They might be selling, like there's a very particular place in that whole universe. So your market, think of it this way. I'm going to reverse it, okay? So we go back to steering wheels. Logically, what I want you to think of is take your product, so if we're making steering wheels, and imagine all the steering wheels in the world that you could sell, that you could sell to. Basically, you could be that steering wheel, okay, for every car that was manufactured. And if you take that number, one steering wheel, I'm just making up a number, $100, let's say, it's probably not, but let's say it's $100. So you go $100 times all the number of cars that are manufactured. And if you could sell to every one of those units, right, that's your market size. It's not the value of all the cars sold. Got it? So that's what's happening in most startup pitches. People are taking some giant number that represents a market, and it's a much broader market. It's not the market for the thing that they're selling. Let's say travel, let's say we're doing something that's going to be for travel and for travel advertising, right? So I have some website and it helps people who, places like Agoda and Expedia, they can actually do advertising for their travel business. But if I say the travel industry in the world is whatever trillions of dollars or billions of dollars, that's counting like the money that people pay to travel. Like that's like, it's a whole much bigger number. If I really want to talk about that market, I should think about what do those companies pay for advertising, right? Because my product is like an advertising product for the travel industry. So I might say, travel industry, how much do they pay for advertising per year for the whole market? Okay, so I'm just doing this really simplified way of explaining it, but like that's fundamentally the problem. Most people are not thinking really back to the real market size. Related to that is also target segments. So let's say even this is your actual target, your actual market. So let's say this is the market for steering wheels, $1 billion. But investors want to know, conceptually, they want to see you thinking, you're not going to sell to every single car and type of vehicle in the world. They want you to segment the market. So chop it up into pieces. So imagine, what are all the different types of market segments that use steering wheels? Chop it up, and then identify the ones that you are targeting. Maybe you only make sense for these segments. They want to know, who are those segments? There was, I've seen you guys pitch before, right? Restaurants, right? And it was a very, very relevant thing. You know, we're talking about, wait, which restaurants? Someone even brought up, wait, is it going to be in the large chains? And you were really clear, no, we are not targeting those. And there's a reason, because you have your value proposition in the fragmented, smaller restaurants, right? That's clear. So identify who you're actually targeting. The more clear you are about that, the more believable you are. Another thing that happens in failure in these pitches is someone paints this whole picture and then they actually say, we're going after this market, but the market is just too small. So this goes back to what we talked about in the beginning. It's just really that reference to you got to be building something that's going to grow to like 50, $100 million per year to be VC fundable. So if your market that you show on your slide is like not that big, you're sort of suggesting that you don't have the potential. So be really clear about that. Another one that's quite subtle is, or can be, is the market, is it shrinking or is it growing? So people want to invest in markets that are growing. So be careful. You might say this market is even big, but if investors see that it's something that's going away, it's dying, it's being replaced by something, right? Imagine if we went back in time and you said you're going to make something, a new innovation for typewriters. Would that have been, it might have been a little risky, right? So you also want to consider that too. Is the market actually growing or shrinking? This can be to your advantage when sometimes if you are targeting a smaller market, but it's clearly a market that's growing rapidly. If that's the case, show that, emphasize that, show the data you have on that. Next one, traction. Yes, question. Okay, so the question is, if we define, target a niche market,
Do you think this is a part of a like potential market? It's just too small to make investments or start up business?
okay. So let me answer. It may be a different way to answer it. Okay, but if you've got a market, right? This is a total potential market, and you show segments, and you point to this slice, right? And that slice is a niche market. It's small. Now, if you just say that we're going after that, and it's just really small, and that's it, we're done, and there's nothing else, that could be a problem, unless either one, it's a niche market that people believe is growing rapidly and will not be a niche market in the future, right? So that's one thing. The other is that it's a niche market that you were attacking initially as a strategy, but with the intention that once you dominate it or you do well there, you will eventually expand to another and another and another. Okay? This is an actual specific strategy that people encourage when you're doing a startup. I'll give you the very popular example is Facebook. So when Facebook started, you know the story of like they did it at Harvard, right? So the story was when they were successful there, they didn't just jump to the world and move to all different things. They went to another university, and very similar universities. And they even, though I actually heard the interview with Mark Zuckerberg at that time, this was a long time ago, he was asked, hey, you're doing well at universities, are you going to go to high schools now? And he specifically said, no, not yet. Right? Because he's incrementally shifting to the markets that are similar. Like they just expand incrementally. But coming back to your question, you can do that. You can hit a niche market as long as, in that case, if you're also still going to proceed forward to other markets. It might just be your initial market is a niche market. But if you're only doing the niche market, that could be risky.
So if you proceed to the next market, so that's meaning it's no longer a niche market because it's getting bigger.
Okay. So two concepts here, right? There's two possibilities. One, you're investing in a niche market that you expect will grow, and it will grow a lot. If it grows a lot, then that means that niche market someday will no longer be niche. Okay, that's case number one. Case number two, separate case, is you are investing deliberately into a niche market. You still expect it to remain niche market, but you're just doing it to start with. And you plan that once you do well there and dominate there, you'll then go into some additional markets. Another market, a market number 2, number 3, number 4, and gradually get bigger and bigger. So you won't be tied to just a small niche market. Does that make sense? Okay. Yes?
I want to add to that. I think another perspective to look at it is a niche market in
Uh-huh.
The pie size is small, but if you add up the global,
Uh-huh.
the total size is also be larger, which could be attractive to VCs.
Okay, that's a twist on that. This depends on how we're defining things. So yes, that would be an example of a niche market, but that is still really big if you're including all the other geographies. So yes, it just depends on how you define it. Yes. Okay. All right. Okay, so I'm going to go to traction next. So for traction, so this is probably one of the, from what we talked about earlier, right? One of the most important things. People are looking for proof that your product will work. The problem that happens so often, and watch out for this, we've seen it happen so many times, they show some numbers, they show dollars or baht, and they show this growth. And the startups say that this is our revenue. But it turns out it's not really their revenue. Don't do this. Be really careful. And a lot of times they don't even intend to do it. But be aware because it can look really bad. So I'll give a very tangible example. Let's say you're Lazada, right? You're a marketplace. You have sellers, you have buyers. Let's say you have a whole bunch of sellers, and last month they sold 1 million baht worth of merchandise. You put that on a graph, and you say, we have 1 million baht revenue. Wrong. That's not revenue. That's not your revenue. That's what's called GMV, gross merchandising volume. That's the value of the transactions that go through your system, but it's not your revenue. In the case of that, your revenue is really some percentage of that. So typically in a marketplace model like that, you're getting a percentage, right? Some percent of that 1 million baht. That is your revenue. And it's really scary because you can be pitching, you show these graphs, you show big numbers, everyone's excited, and then suddenly someone double checks the numbers and you realize, oh, no, your revenue is actually like a fraction of that. Okay, so be careful. That's a big pitfall. Next one, showing projections as if they're a traction. So when you have this traction slide and you show a graph going up, but if a bunch of those numbers are the future, that's not traction, that's your projection, that's your forecast. So either be super crystal clear about that or don't even put it there because it's not traction. Traction is meant to show things that have happened that are indication that you have progress and success. The product stage, unclear. A lot of times we see a pitch and we're just scratching our heads like, so does this exist? Did they actually launch the product? Is it out there? Shouldn't have to ask, right? You can say we launched at this date or this will be launched when. So make that really clear. This one's tricky. So sometimes you have a startup show traction, but the traction is for something they did earlier. It's not the actual thing they're pitching. Right? So sometimes they created a certain business model, they got some traction, and then they pivoted. They changed their model to something else. And the pitch you just saw was for that thing, the new thing. But the numbers they showed is for the old thing. So be really careful. Sometimes they do that, and people get excited only to learn later, oh, that's not really the traction for what they just pitched. It doesn't mean you can't show it, doesn't mean you can't talk about it, but be really clear about it so it doesn't look like you're trying to fool or trick the investor. Very dangerous. This is, again, back to that very specific thing called the unit economics, but for those of you, if you do know it, be careful with what's called CAC, customer acquisition costs. A lot of people miscalculate it. They think it's something like, for example, we paid this much on Facebook to get someone to download the app. Right? That's in very technical metrics, that's actually cost per installation. That's not cost per acquisition. So customer acquisition costs, CAC, is more like how much do you have to pay either for marketing or sales or something so that people come in and actually become a paying customer to you. They actually buy something from you. That's CAC. So people mix up these numbers and they end up saying CAC numbers that sound great, but they're not, and it just shows that you don't know what CAC is. Be very careful about that. Showing page views and other what they call vanity metrics. So please know that a page view is just not usually that representative of traction. It's just, you can just get people to come and look at your page through some kind of marketing, but it doesn't mean they did anything. They might not have done anything of value. They didn't use your product or your software or application or whatever it is. So, and similar to that is using social media likes and follows as a measure of traction. So you see startups proudly present, yes, we have this and our Facebook page has how many hundreds of thousands of likes. Doesn't really mean anything. It just means you probably paid maybe paid some money to get people to come to your Facebook page, but they're not actually using the product. The real metrics you should be showing are what are called engagement or retention metrics. So this is another pitfall. People don't show these. So these are metrics that, without getting too technical, they're metrics that actually show that people are using your product. Right? On the relevant actions and functions on your product. How much are they using it? How long they're spending? Transactions that they're doing? Whatever it is that makes sense for that particular product. And then retention is even deeper. It's actually one of the most important metrics out there. And again, this is another separate 1 hour talk by itself. But retention basically measures if people come back to use your product again. And retention is the number one measure of what you call product market fit. So when you make a product that's really good and really serves your market, your user will use it and use it again and again. It's one of the best measures that you have product market fit. Right? So a lot of people don't show those metrics. Another one, this is now very common sense, but you would think that it is, but so many people pitch and you ask them and you check, and it turns out they never even talked to a customer or a user before. That's quite scary. So don't do that. I mean, it's even not talking about just pitching, just building a business. Make sure you talk to users. One of the most important things you can do for any business is talk to your users and customers. Next one is competition. This is just a couple points here, but this one, and almost any investor or judge will smile from this too. They roll their eyes. Right? Thai people will say "mong bon." So, so many startups say, "Nope, we have no competition. There's no one in the world that does exactly what we do." But what they're thinking in their mind is that no one does exactly what we do. So then, therefore, there's no competition. But that's just not realistic. You should consider that almost everybody has some form of competition. It may not be direct, absolutely perfect, exactly the same as you, but there's something out there. And for you to claim that there isn't is usually a sign of a lack of maturity, right, or naivete. So figure out what it is. There's something that you're competing with, and talk about that. The other one that's a variant on it is not knowing that there is someone. Now there's a difference between the first one and the second one. The first one is you know that there's something similar, but you're choosing to say they're not your competition. The second one is that you actually don't know. I'm not sure which one's worse. They're both pretty bad. And then this one. We saw this recently, and we had to help guide one of my partners, this brilliant investor, Robert Lomnitz, right? And we screened startups together. And that was a really good startup. And I remember in their pitch deck, they showed themselves and their competition, and there was a table, and the table basically showed that the competition had nothing. There are all these features, and they have nothing, and the startup has everything. And it's a little bit too unfair. And not credible, right? And it was true. I mean, once we dug into it, it's not that perfect. So if you don't frame it so unfairly that it's so obvious that you're just saying, they have nothing, we have everything. There's something It's okay for there to be competition. And even this is related. Like, once upon acknowledging that competition, make it clear what are the differences. Sometimes it's not even a matter of saying that you're better, right? Competition isn't only about a win and lose. We're better than the other person. Sometimes it's just we're different. They target certain things. They serve things. They're more focused on certain things. We're more for another thing. That's fine, right? So the investors just want to see where are those differences. Where are you focused? What do you fit more? Where does the other person fit more? It's not just win or lose. Advantage. Sometimes there's a slide called advantage or unfair advantage. A couple things here. Be careful about overemphasizing your brand. There's a lot of startups that kind of say, our advantage is we're going to have an incredible brand. We're just going to have this great name, great logo, great story, great branding. Be careful, because when you're a startup, you don't have a brand yet. So you're basically saying you're going to build a brand that's really big, and that takes time and money and resource. So it's kind of not a thing that you can claim. Yes, you can go and build a brand, but that's not what you put on your slide and say, that's our advantage. It's more like that's the advantage we hope to have one day. Right? So don't use that as your advantage. Overemphasizing first to market. This is overhyped. People like to say we're first, and they think like, that's it. See, we're first, we win. And like, I mean, in a lot of MBA courses you'll learn, right, that there's so many people who were first but didn't survive. It's not only always about being first. And it's quite overrated, actually. So don't rely too much on just that. This one is more on the, especially for deep tech. So for those who do have patents and intellectual property, I've seen cases where someone pitched to me and they showed this slide, 3 patents. And then there was no real discussion, nothing talking about what they are. And upon asking a few questions, I learned the patents have nothing to do with the product. And it didn't have any competitive advantage. It was like just throwing some patents that were related to something else. That's not good. You don't want to lose credibility and trust that way, right? And so if you do have them and they are real, highlight, say something. There's a patent for this thing, which is really important and gives this advantage and this feature or benefit or whatever it is, right? And this one is a really big one and a big potential opportunity for Thailand. We have a lot of amazing research, a lot of talent, but there are times even at Bangkok Venture Club, we bring in startups that have gone, that have good traction and progress, but then we learn that their intellectual property hasn't been transferred properly. So it was still stuck in the university. They don't have the actual ownership, or the terms are not good. Something makes it so that we can't invest. It's not investable. So make sure to be really aware of that and have a clear path to what's called the IP transfer. There are barriers to this, and there are issues systematically, and Thailand has begun giving attention to this, and we're all trying to help together to improve. But in the meantime, be really aware of this. And then another one is not having the global IP rights. What this means is sometimes there are startups that they represent another company from, let's say, the US or another part of the world, and they have exclusive rights to use the same technology or something like that in our part of the world. I need you to understand that for most venture capitalists, most investors, they don't really want to invest in that. They want to invest in something that can scale really big, and you don't want a limitation that, oh, you can scale but only in Thailand, only in Asia, only in something. You want to be able to scale, ideally to the rest of the world if you need to. So coming in with something where you say you're basically like a subsidiary or a franchise really limits your ability to raise funds. So please be aware of that. Team. One is a lot of people just don't even have a team slide. That's a bad sign. Team is one of the most important things. Don't miss that, please. There's no team balance sometimes. So sometimes it's like engineer, 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 right? Or business person, business person, business person. There's no technical person. So there's a term that some people like to say. They say hacker, hustler, and hipster, which really means like there should be a technical person, There should be a business person and maybe a creative or design person. It's not set in stone, it's not a formula, but you get the basic picture. There should be some balance in the functional roles. Okay? We're looking for some completeness there. Sometimes there's no history or significant history of a team relationship. You don't want to go in and say, well, we met yesterday at a meetup. Right? Or we met on Tinder and decided to just do a startup, you know? Right? That's not it. So you should have some kind of history of working together, friendship, something is better. And if you don't, you can do what they call it literally founder dating. So like take some time to do some things together, create, for your own benefit, not just a pitch. Like you want to get to know these people because you're basically getting married to them, to several of them at the same time. And another one is no relevant background and or inspiration. So people do look for the story. There should be something tying you together. So if you're doing a startup, either your domain expertise, your previous work, something that connects you, if nothing else, at least to your functional role. Or another one is an inspiration. So sometimes people may not have been from the industry, but they suffered a pain. That people love it. Investors like it when you are creating something to solve your own pain point. That's quite attractive. And so you actually can say, wow, I used to suffer this thing and I wanted to build a solution to solve that problem. Or my friend or my relative or someone I care about. That's more compelling than just, I did an analysis on an Excel sheet and this looks like it's the way to make money. That's not very convincing as a team. And we're almost done here is the ask. The ask is basically the slide that says, what do you want? So again, a lot of people don't have an ask slide. Now imagine, if you're an investor, you're there, you're interested in giving something and investing, but like someone just pitched to you, but you're basically like, so what do you want? What are you here for, right? Typically it's raising money. Maybe sometimes it's not, sometimes it's for some kind of help or network or partnership or the combination of those things. But whatever it is, you got to ask for it and you got to be clear of what it is. Sometimes it's not raising enough money. So this is good to know. Some people raise an amount of money that only lasts like a short amount of time. Like say, oh, I'd like to raise X amount, but it'll only last them like 6 months or something, or a year. That's typically not, doesn't really make sense. Why? The reason is when you raise funds, typically in this sort of startup world, you raise funds, you build up your traction, you get to another point, you hit certain milestones, and then you raise another round to go to the next step. The thing is, when you raise again, it takes time. The rough rule of thumb that people suggest is to plan for at least like 6 months. You don't just step outside your door and go, hey, looking for some money, and someone just gets it to you. It takes some time. So assume it'll take about 6 months. Given that, that's why people say, raise enough so that you have about an 18 to 24 month runway. Which means, in other words, enough money so you can last about 1.5 years to 2 years. Why? Because you want to spend the next year or so actually doing work and building your traction, getting to the next place. And then you want to leave about 6 months for the fundraising, right? So that means that when you raise, you want to raise enough so that you can last that. Don't make it too short. And if you do, it kind of shows that you might not understand how this works. And then sometimes they put down how much they're raising, how much they want, but they don't say what they're going to do with it. So this is something that's a good sign of your seriousness is, I'm going to raise this much money to do this. Usually one good way is to show, like, for example, a pie chart. How many % for marketing, how much for technology, for development, how much for new hires or sales, et cetera, et cetera, et cetera. Right? Why? Because that communicates that you have a plan. You're not just saying, give me some money. You say, I have a plan, I know what I need to do, it requires this much money. This is how I'll use it. Right? So show that. That's the use of funds. And then also, a little bit more advanced, but really good, is your target milestones. So with this money, knowing you're going to spend it on what, knowing that you're going to take this 18 to 24 months, what are you going to achieve with it? Have in your mind that you're going to build up basically like the graph, the future graph that you plan to create with this resource. So what are you going to achieve in the next 1.5 to 2 years? And with that, it will allow you to raise your next round or go to your next stage. The clearer you are about that, the more that shows that you know what you're doing. If you're just saying you're raising, but you don't know where you're going, it's like saying, please loan me your car, give me a tank of gas, but I don't know where I'm driving, right? You should be able to say, I'm going to San Francisco and it's going to take me this many hours. Right? I'll be there by this day or this time, and I'll go by this route. Okay, now we get to something really, really good to talk about. People don't get to talk about as much. It's valuation. This is so tricky. A lot of startups think that they have to have a high valuation. And when they're negotiating, they're trying to negotiate to have high value. And just to be clear, what is valuation? Valuation means like, let's say I'm raising money from you. I'm raising 250,000, like the gentleman over there, right? And I'm saying, can I have 250,000 from you? And then for that, you're going to get some shares, right? A percentage of my shares. So depending on the percentage, that will set how valuable my company is. So actually, let me use different numbers for no, I'll go with the 250. So if I say $250,000, right, and I'm going to give, so who is it? I'm raising it from you. So I'm getting the money from you, and I'm giving you 25% of my shares when I raise, okay? That means that the value of my company should be 4 times 250,000, right? So I'm valuing it at $1 million. So if you give me 250,000 and I give you 25% of the shares, that means the company is basically worth $1 million, right? So by doing that, I've set my valuation at $1 million. The problem is startups are negotiating and fighting for a high valuation. They think that the bigger the number, I can only give, what if I give you only 10% of my shares or 5%? That means my company is worth more, right? And a lot of startups are negotiating for this. They're fighting for this and negotiating and haggling for this. Now, there's a very dangerous thing, which is this. If you get a valuation that's very high, and it's too high, valuation that does not really match the type of traction that you have at this time, it's overinflated. You may celebrate. You may go home and say, I got a great deal, right, as a founder. The problem is, what happens in the next 18 to 24 months? 18 to 24 months later, you're going to raise again, right? And when you raise the next round, this time you might raise, let's say, $1 million or something, right? And at that point, the valuation is going to be expected to rise. It needs to grow. It can't be just $1 million. You need to have created more value, right? Your original investors will expect that. The new investors will expect that. But what happened? Because you got such a great deal, right? Someone gave you too good of a price. Then when 2 years rolls around, or 18 months or whatever, right? And you raise, and your traction is not really that good. Reality comes in, and the next investor comes in, and they don't give you a higher valuation. They say, you know what, you're not worth $3 million or $4 million. You're still worth $1 million. Maybe you're worth just a little bit more, or maybe you're worth less. That is disaster. It's what's called a down round. If you go down, right, if you go down value, or a flat round if you stay flat. The problem is, it triggers certain things in your agreement with your previous shareholders and all sorts of just complexity that can destroy your value. It can make things really, really painful and mess things up for you financially. You do not want a down round, right? So you really want to avoid this kind of thing. And startups don't understand that. They think that I want the best deal. I want someone to give me like the awesome deal so I can claim I have such high valuation. But if you're not really worth that, you're just setting up yourself for what could be permanent failure, right? So really, really be careful. People watching, be careful about that. Don't overinflate your valuation. You want just a reasonable one so you can move forward. And then, this may seem strange. I just told you, be careful, don't go for too high a valuation, right? Well, also don't go for too low a valuation. And by that, I mean like way, way too low. Now, let me be clear. Typically, let's say when you're doing a round, let's say, I'll use an example of a seed round. You're raising a couple $100,000. The amount of equity that investors are coming in, there's a rough approximate window that's sort of in the realm of reality. Just really, really roughly speaking, it's sort of this 20-30% range, roughly. Okay? There's some plus or minus. But if you go too extreme, you can actually end up where the founder has too little equity left. They have too little of their company left too soon. That's called dilution, dilution. The problem there is that the incentive for the founder to keep going and building the company all the way to the exit, to the IPO or being bought, starts to disappear. It's like they don't have the ownership and they won't have the financial gain. So if you set the valuation to very, very extreme in the other direction, which can happen if you deal with some very traditional, really old school investors who might not understand like startup investing, like tech startup investing, that can also ruin things. It can ruin things for the startup and for the investor. The investor may have just prevented the startup from raising their next round, which hurts the investor as well. Okay, so I won't get too technical in this. Like, I really want to more just deliver the key message that be aware of these things. A lot of people make these mistakes in these pitches and don't develop an appreciation of like the reality and how it affects their ability to move forward. That's my main message here on this. Cap tables. This is basically be careful. It's actually similar to what I said before. I'm going to actually skip this one. And then this one, retaining an irrelevant SME side of the business. So there are some startups that were created by doing like a traditional business, like an SME, a non-tech startup business, and they even made money. Right? And then suddenly one day, so by SME, let's say it's a very, very low tech, maybe it's uses a lot of people, it's not very scalable, and it generated revenue. And then one day, from that business, they started creating something that was more innovative and had more tech to it, and became a tech startup. What happens in a lot of our startup community is the company has two sides. They have the old one and the new one. And sometimes the old one is not really relevant anymore, and it's not the core business. It's not the business that you're about to raise funds for. This can create complexity, and in some cases the investors don't want to invest in that. They're investing in the thing that's going to scale, right? The thing that we talked about in the beginning. So be aware of that. Sometimes there's this emotional thing where someone built a great business, but it's an SME. And it's an SME that doesn't belong in this new business, right, sometimes. And sometimes the right thing to do is to separate them, spin it off, and then go raise funds for the innovative side. So be aware of that. And the problem is it's really emotionally difficult to do for a lot of people. But it can actually prevent you from fundraising in some cases. We are now at the actual last one, okay? So this one is about Q&A. And I don't mean Q&A here. So this is a subject near and dear to my heart. When we talk about pitching and people talk about pitching in the startup community, they've emphasized the pitch. But you know what? One of the most, if not the single most important part of a pitch is actually the part after the pitch. It's the part where you get the question and answer. And so many of these get ruined right here. So many people, if you're talking about pitfalls, huge one right here. So, number one, when it's time for the investor or the judges to ask you questions, don't do this, which is like, it's not listening, right? So not listening to the question. Someone can ask you something. We see so many times the startup just says something back and it has nothing to do with the question. Right? So really focus and listen to what the investor is asking you. Try to answer the question. Sounds simple, but I'm telling you, people mess this up all the time. Answers that are too long and rambling. There's a practical reason for this. It's not about you being like the best speaker in the world. It's not about any of that. It's really practical, which is about time. You have a limited amount of time to talk to each other. The investors do have questions for you. They want to learn more about you. They want to give you the opportunity. But if they ask you something and you answer something super long, you run out of time, right? You run out of time and they can't ask the other questions. That's just missed opportunity. So try to regulate yourself. Be aware of how long you're going. This one, not listening to and considering feedback. So a lot of times an investor might have an opinion that's they might disagree with you. They might be like, well, how about this or how about that? First of all, listen to it. Think about it. You don't have to agree, but show that you're actually listening. And if you don't, it's such a sign of danger, because it means you're not coachable. You're hard to work with. That means if they do invest in you, and then someday in the future they have a question, or they're like, "Wait, could this be better?" or not, you won't even listen to them. No one wants to work with you, right? If you're like that, it doesn't mean you can't disagree. You can always say, "I really understand. I get this and this and this, right? But I'm just." Be diplomatic and be good about it, right? This one for sure, rude, arrogant, and insulting attitude. I've seen cases where it's just horrifying. Like they just don't insult your potential investor. I know it seems like common sense, but I've seen it happen many times. And I understand there's a little bit of like part of entrepreneurship comes with these sort of a certain amount of confidence, right? And ego, and that's okay, we understand, but like, don't cross that line and become rude and impolite. Do not, because at the end of the day, investors are still people. And then with all that said, again, these things almost seem like they're conflicting. It's like, be this, but don't be this. Not too high, not too low, right? Just right. So same thing here, like, yeah, don't be rude, don't be all these things, but still have a backbone, have confidence, have your opinion. You don't have to agree with everything. That's okay, but strike that balance. Do it politely, do it intelligently, right? But still be confident. So I actually heard there was the interview with some Silicon Valley investors the other day, and they even said sometimes they're challenging the people almost on purpose, and they want to see, will they just agree? Right? This is not saying just agree with everything. No, that's not what he said. We said listen, right? Like listening, considering, not being rude, but it doesn't mean you have to agree with everything. You can have your position and be constructive about it and positive. All right, that was the last one. So, yes, questions, please. Yes. Sure. Okay. Yes, that's good. So, one, don't BS. So the question is, what any tips on if you really don't know the answer during Q&A, right? What should you say? So it's first of all, that's okay. It's understandable, right? So you can say that you don't know, right? But it would be good if you do show some extra an extra step in that. So you might think, well, you don't know, but you think this is how you might get the answer, or this is what you would do to find out, or express something to show that it's not just you don't know and that's it, right? Or you don't know, but your initial thoughts are that it might be this and this. This is just not unvalidated or something, right? Be very clear. Whatever you do, don't just BS. Okay? And that's true not only for this Q&A and startup stuff, this is in general with general just management and corporate and business culture. And yeah, it's okay to be truthful in that way.
Second question, what would be attractive to you as an investor? Start with the pitching, or you want to hear the pain point first,
Ah.
then go to the solution? And what is the last thing that you would like to prove?
Great question. So, and yeah, people are really passionate about talking about this. A lot of investors. Well, first, to be really clear on one thing, I have to preface everything, both this answer and everything I even said. Please keep in mind there's no one correct answer for everything. Not all investors are exactly the same. There's no one rule book. Okay, so there's variation, right? But there's quite a pattern, a majority pattern that we've seen. So the very, very popular thing is start with a problem. Don't start with a solution. Don't start with some large vision. Start with the problem, the pain point. Right? That's one of the most commonly prescribed things to start a pitch. First the problem, then the solution. There is a variation I've seen from some investors, in particular 500 startups in the US, and I think there's some real logic to this. They recommend that if you have really good traction, you have some certain metrics that are quite impressive, you might want to start the first sentence or two with a highlight of that. So you might say, begin with, we are currently achieving X amount of growth and revenue, X percent revenue growth week per week, or whatever the traction that sounds really impressive. That's a pretty good way to get investors' attention, and they'll really want to listen to the rest of it even more, right? So now this is not a hard and fast rule, that's a suggestion, but I think it does have some logic. But otherwise, problem and solution. Okay? Oh, the last thing, I'm sorry. The last thing is really it's the ask. Typically it's the ask, which is, so what do you want, right? There's a variation I've seen on that can be really effective. I think I saw Eatigo, the guys who pitched Eatigo several years back do it, and they were one of the first that I saw to do it here. And it was after the ask, they had a summary slide. So they actually created this really convenient slide that took a couple of the most important key points of the entire pitch, put it into one place. I thought that was really clever. A lot of people really thought that was good. Okay, so it's either the ask or some kind of summary slide, is my suggestion. Other questions? Yes.
I don't have a question, but I just want to, share the experience with the investor partner that we have. Actually, we address the risk element, the reduction of risk for our investor partner. So we, are able to sign up with them with, $10 million commitment for that, reduction of risk. So I think, when you approach the pain point or whatever, it has to be approached from the realistic point of view of like what is the risk element that, your investor or people are facing, whether it be like, cost management or I think there's because I'm actually not working with, I'm not a startup, but I'm actually working with, public company to actually bridge the gap, to be competitive. So that I think there's the room for that as well. And it's scalable, so it's,
Yes.
yeah.
So if I may, to sort of connect to one of your points, risk, right? Risk management, that's very closely related to traction. So what is traction when an investor sees it in these slides? Traction is helping to de-risk things, right? Because what it's showing is not just what we think might happen, what the pain is, all this kind of thinking. It's more like this is proof that someone, some customers, some users are actually getting value from your product, and it's growing, right? So traction is one of the most important forms of de-risking for a startup, especially at these early stages. So that's the risk management for startups. Well, I don't know if that was necessarily, I just inspired that, but yes.
What's the number one slide
The one slide that I see people struggle with the most. So I don't know if I use the word struggle, right? But if I had to pick a slide with the most problems or pitfalls, it's the problem slides. Problem slides first, because it's just, yeah, it's just back to, because that's what forms the value proposition, right? So if we don't understand, like, what problem are you solving? What are you fixing? Why is that an important thing? We don't know the thing that drives everything else. You could have a nice business model, but and you could have a plan and a marketing plan and all these things, but like, everything starts with the value proposition first. It's got to be like some really extraordinary value, especially in the case of a startup. Right. The next one, I would pick one more, if I had to pick right off the top of my head, it's traction. And traction is kind of interesting because it's no longer even really just about the slide. I mean, yes, there's things that I said about the slide, like what you say, what you communicate, all that. That's a bit more technical. But at the end of the day, the traction represents what you actually did and the result of it. So by definition, people struggle with that the most, because people struggle to create something that's working and that people are using. It's the number one factor for why startups fail. That's according to CB Insights research. Yes?
I think we are running out of time. Can I have one last final question, please?
Can we do two? Were there two people? Can we handle two?
Okay, two final questions.
Thank you. This is your lucky day.
Questions about the team.
Yes.
You like really start out, so you don't have an impressive team member yet. You kind of hire freelancer and supplier. Do you put those people as your team?
Freelancers and
It's just you and a bunch of freelancer and suppliers.
yeah, that's not really a team. Doesn't mean you can't talk about them. It doesn't mean they're not important. But when people are looking at the team, let's go back to the investor's point of view, right? These are the people who will have the commitment to drive this thing all the way through, right? So they want to see that you have a certain completeness between those founders, that core group. So based on that, it shouldn't be freelancers and people that are floating around. It should really be the team. Oh, okay. Then it's the truth.
Let's just like skip it.
No. 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 So you tell the truth. You show. I mean, we've seen it. There are startups with a founder of one or two, right? And people discourage it. Most investors discourage it, but they do exist every once in a while. There are some that have succeeded. I mean, they eventually get a team, right? And then the other way is that you might end up starting that way, but if you're impressive, people may help you, and you may be able to move forward with that, right? So yeah, I mean, you put down what the truth is, right?
I have an add-on to that. What about employees, but not as like very skilled employees?
Right, exactly.
So like one 15,000 baht employee. Do you include that? Like say for example you're a tech person, you're like
Yes.
a programmer, and then you do most of the coding yourself, but then you can't just code every single thing in that thing, and then you don't need another person who's like really as good as coding as you, but you need like at least 4 of the 15,000.
Okay. All right. So first, I've never seen a hard and fast rule about that. I've never actually encountered this. I mean, it's an interesting question. I don't know if some of my colleagues would add to it, but let me wing it first and let me try my initial reaction. I would think that if you have team members, you have employees, and they're not your founders, you probably still have a small team anyways, including them and showing who your personnel is. This is assuming you're not talking about putting 20, 30, 40 people on a slide. That wouldn't make sense, right? But if you are a team of like 5 people, and right now a couple of them may be not your critical people, but they're part of your team, I think there's nothing wrong with that. There's not so much a should, but I think in my opinion you could, And it's going to come up in some way, shape, or form. People are going to want to know how big is your team. It might show up ultimately in your Excel and your financials, and you see your head count. But knowing that you have that many people right now, I don't see anything wrong with that. And I think it's fine as long as you don't have too many people, because then it's just kind of ridiculous to have too many people on your slide, right? But if you have a small amount of people, some are more critical and some are less, I don't see anything wrong with that. Freelancers, though, I think it's a little bit weirder. That doesn't seem like it's really so much possibly. But this, I have to say, whatever the case, we're talking about like an edge, what I'll call an edge case. It's not, to my knowledge, it's not a big deal. It's not the critical thing. Someone's not gonna, it's not a pitfall of pitching. It's a pretty minor issue. So I don't think people are gonna think that much about it, really. That's my, maybe from my colleagues in the community and the investor side, anything you want to add to that? Or
You might want to turn it around and say that, the investor might have the team that you may need. So you just, put it in a positive spin, yeah? Rather than, I'm like only one-man show. It's like, I may need this and this from the investor. And the investor will be willing to help, because that's what team is all about. And the investor has to be part of your team. That's what we do with our investors. They're very engaging and, and so I think you'll be surprised, how willing and helpful the investors are. Yeah. So we just say no to you once, and they might, be able to help you with other things. It's not just about money, but resources also
true.
count. Yeah.
True. That's a really good point. Anything else?
Yeah. Well, actually, one of the things that you really want to be careful the way you present it. Here's a trick. Some people, when they have team, but not really a CTO, CFO, CMO, COO, people to help them, they would show themselves and they would show, a bunch of the freelancer. It's kind of great, but and that team, together, all smiling, this is a team that made this happen together. Okay, that's in a way a positive spin on it. But, however, be aware that during due diligence, when the investor actually come in to talk to you, they realize that you have been alone, and that after a year and a half and you're still alone, there's a different way for them to infer that. They could say, well, you could be a genius in a way, we don't want to believe. But, because here's true, startup is hard. It's really hard to get a startup who, a founder would be a genius and he could do everything, and his vision, his mission, his work ethic is so strong that no one else can match this, and he could just, delegate everything else and hire the best people. But usually, people, would not be able to do that. And investors who have been to single founder, I have been through that, would realize that a lot of time it signifies that you have problem working with people. Okay, that's one thing. That's one possibility. Two, you have problem attracting good people. That's going to come up to bite you. Why? Because as you grow, okay, even you will need to attract talented people. Now, as a founder who carry the vision, if you cannot attract good people to join, your growth ability will cap. Even if you have money, when you get funding later on, if you cannot get good people to join you, it's not going to grow. So that's something from experience. So that's, it's like Kun Sam says, it's not exactly a pitfall, but some investor doesn't care too much if your traction and business model stand and it's really sound. But for some investor, if you're still kind of weak, your traction is still kind of weak, if you don't have that, that's can become a major pitfall.
Thanks. Thank you. Goodbye. All right. I
have
think.
one
Oh yeah,
last finals
we owe you.
question.
Okay. Yes. Last question, right?
On the other side, can you share what is the pitfall of the investor, like the common pitfall, or from your experience, like something that we can avoid very easily in the beginning stage
For
we invest?
for the investor. Wow. Okay. Yeah, I mean, I don't want to overclaim that because even for me, I don't have like that much, huge vast experience with that.
Well,
but-
I want to share one story. Actually, this was what I read earlier from Bill Gates. His regret is not, be able to start the Android. That's what his regret is. So that's probably like, the investor. The investor, from my point of view, is basically like, regretting not investing. Like, this guy Shamad, who actually joined Facebook, later, a year later, And he said, I should have joined a year earlier. I would have made, gazillion instead of like being a billionaire. So I mean, the timing and also the inability to go in earlier and invest. So I think that's a pitfall for the investor, not seeing the vision of the startup. Yeah, not be able to capture the value early on.
So, and then, so if I can add to that, right? So, okay, a couple of things. First of all, most investors realize that they won't be able to make all the right calls, right? And this is, as we showed you in how this investment works, it's like the needle in the haystack, right? And so, they're by definition are going to be full of failures. Most of the startups are going to fail, right? But if I come back to the core of your question, pitfalls to watch out for, I'd say a big one that most people would agree is on the team and sort of a due diligence of the team. Because especially at an early stage, it's about understanding the team and who you're working with. It's less about they know that at these stages the ideas change, the visions, the market, everything pivots like crazy. These things are not stable at an early stage. The thing that will make or break the startups are the team, their ability to go through the change, the ability to get through conflict with each other, their communication, their motivations, all that. So the pitfall, I would say, is making a decision without getting to know the people enough. Spend some time with them. Don't just look at, despite everything that I just said, don't just look at the traction. Don't just look at the numbers. It's a people business, ultimately.
So in practice, how can you investigate this?
Sure.
In practice,
Yeah, great question. So a lot of investors will not just will actually take some time to meet with a team and give some space. So in other words, let's say they talk to you, or they talk to the team. They see the pitch. They go, "Okay, this is really interesting. We're really interested. Please keep us posted. Let us see how you do over the next month or 2 months. See their accountability. What did they report? Did they do what they said they're going to do? How did they take the feedback? The investor might have said, do you consider this? Can you just consider that, like in the Q&A? What did they do with that? Did the team think about it? How did they react to it? Right? So spending a little bit of time to investigate those dynamics goes a long way. And so a lot of investors do that. And actually spend a little bit of time to really do that kind of to get to know the team. And so the flip side of that as a startup is this is an opportunity. So when you talk to an investor, send them updates, right? Have a regularity. Show them that you say you're going to do this, and come back and show that you did that. Or even if it didn't work, how did you respond to that? Show your feedback loop and your cycle. Right? Does it help? Thank you. Thank you. I think we're out. So I'm happy to talk to you and anyone else afterwards.
If you have any questions, please
Thank you
feel
so
free
much.
to talk to Kun Sam afterwards. We have like heavy finger foods waiting for you outside.
Finger foods.
And please feel free to mingle and stay around. So please
Awesome.
join me. Like, our applause to Kun Sam.
Thank you so much, guys. Thank you. Thank you.